Ladies and gentlemen, welcome back to the Capital Flows live stream. We're doing a daily live stream every single day, breaking down the macro regime, talking about the different asymmetric bets that we are taking, and every day, 8:30 a.m. Mountain Standard Time. So appreciate you guys being here, showing up. I'm always covering the macro side of things and how the different information that we are seeing is playing out in financial markets. And James has covered a lot more on the mindset side and how to really pull all those pieces together, depending really where you fall in the left tail, right tail. So you get a little bit of everything.
How you guys doing, by the way? It's a good day out there for hyperliquid enjoyers.
Is it up on the day?
I don't know. Let me check. Yes. It is up on the day.
Here
America still can't touch it.
Here's the risk reward that I shared previously. This is the shorter term one. Obviously, if everyone who knows that I've been sharing the purview since we've been down here in sub 350s. We're now up over 150% from those levels. And then for people who kind of came a little bit later and they're saying, oh, well, how do I think about the risk reward of where we're at? Why is that taking place? About a week ago now, I shared this risk reward and just said, listen, we're seeing the factors for the thesis continuing to confirm not narratives, but the flow. And I think that's a key thing because a lot of people see any kind of name or whatever it might be bidding. And what do they immediately do? Oh, top. Just immediately call top, no matter what, without any kind of thought given to how exactly the underlying situation is taking place. So the overwhelming force that we're always going to have in these sessions is that the entire industry is set up to suppress risk, not take it. And at the end of the day, for people are beginning to catch on. If you're in the comment section, you get paid to hold risk. That is the entire point of markets, is risk taking, not volatility suppression. And once you begin to understand how risk taking works, once you understand how volatility works, then you begin to understand how all of the people that have structured products in the financial industry have structured them not around risk taking, but around keeping their job. And if you see that that's their incentive, you can understand how with an informational edge and an actual risk-taking time horizon and volatility preference, you can make superior returns than anything that the industry provides. And that's the entire point of generating alpha in markets, is to be able to outperform those different just products that people are always kind of sharing and talking about. And so, if you're new, go to the Capital Flows Research website. You can see everything laid out here at capitalflowsresearch.com. And the place that I want to start today is with an article that I just published. And it was published yesterday called the 2026 AI Deception and Coming Storm. And the reason why I took some time to write this, and I want to break it down even further in today's session, is because there are moments in time when you want to take a step back and think about where you are in the overall system, to gain perspective and to say, let me zoom out a little bit and think about all of the things that I've assumed to be true and test those and say, where do I really fall on these different things? And a lot of the ideas that I laid out in here center around the idea that a lot of the practices people have that have been normalized are really detrimental to understanding when we are going to shift into a bear market. That's the main idea. I started by saying there's a continuous feed of disoriented information that is intentionally desensitizing you to the signal in markets, or even worse, manipulating your perception so that you can't tell what is true or what is false. All of us experience this to varying degrees as we navigate where we are in the cycle. And this is key. Monitoring the situation has become the new way to orient yourself to a world where extreme outcomes are building under the surface, but then reveal themselves in a moment of volatility. So everyone now is monitoring the situation. We even have restaurants named after this exact thing. The dark side of this, and I'll let James kind of speak to this idea, is that being terminally online and quote unquote monitoring the situation basically always results, or almost always results, in endless doom scrolling as an unintended consequence. Or sometimes you just know that you're going to do it either way. And you say, oh, I'm going to go monitor the situation. We've now relabeled doom scrolling as monitoring the situation. And it is not the mechanism that is going to help you think clearly about a situation and think about your risk, because you're always chasing and seeking for a piece of information, a confirmation bias, or whatever it might be. And then you kind of turn your brain off and you end up having the mechanism that's feeding you information and you need to filter it become the thing that you just turn your brain off on, and it takes control over you. And, you know, I'd love for James to kind of expand on that a little bit more and kind of talk about that, because it's something that people are not really talking about as much, about how, you know, people who are online, or you need to be online or need information, have this risk of doom scrolling and the unintended consequences of it.
It's actually a really interesting tidbit you just added there at the end that I hadn't really thought about, is that we often doom scroll these days. First of all, we know it's bad for us. Yeah, we still do it, right? That's that's not great. But this idea that we do it to kind of relax and tune out. So it almost sends us into like a hypnotic state. And when we're in this hypnotic state, we're like way more susceptible to ideas being put. We're not in a defensive stance, right? So we're not thinking critically. We're just off. We're effectively like idling. And we've talked a little bit about privately this idea of the extraction of the demise of culture and the demise of an empire and all that, and how people are positioning to do that. And we think as these young people, oh, well, okay, maybe not me, I'm a little older, but like we think that we're like above the propaganda. We've figured out that like, hey, if I just get all my news from X, like I'm not like the boomers, man. I'm not like the people who still watch Fox every night. I'm above that. And in reality, we're just creating the new propaganda, the modern propaganda. And we're all falling prey to that, especially with AI just pushing it more and more. And then we're in this hypnotic state and we start to think that we know something different, or that we're outside of the box. It's like that whole thing where like you think you have these novel ideas, but like every idea ever has been like thought about, right? You're not really creating novel ideas ever. So I find that really interesting. We also think that a lot of the monitoring the situation is like a good example where the Mark Andreessens and the A16Zs and the people, they see that and they're going after it. They're trying to capitalize on this by getting more and more mind share in the area where it's like they're just preying on this thing that we think we're in this safe zone, this freedom area, this ability to seek truth. And they're like, yeah, sure, whatever. Keep thinking that, and we're going to just plow you with all of this new modern style of propaganda. So I think that we all need to think deeply about that, and then think about how that's going to impact the movement of money and flows and mind share.
Yeah, I think the reason why I said intentional deception is that all of this is fed to you under the guise of being well informed. Right? Like, oh, you know, this is going to help you a lot. This is going to help you be aware of everything that's happening and why it's happening. I mean, if you're not impacted by a lot of the factors, or intentionally trying to gain an edge in an intentional way, and it's just for entertainment purposes, I mean, they're intentionally trying to create fear in you that is not for your best interests, right? And that's why I said, as a result, the closer you look, the less that you see. And this is kind of the phrase that I have now for how I think about that situation. And so the biggest problem I see today is there's a massive divergence between what people are focusing on and how the system actually functions. This divergence grows with every day that passes because AI is retooling every aspect of reality. It has converged with a surplus of liquidity in the system. So the speed of the system is increasing. The fact that just the speed is increasing is disoriented in itself. I mean, the fact that we have so many things changing so fast in so many new ways. I mean, think about how everyone was so sure that it's impossible for things like Hyperliquid to rally if Bitcoin doesn't rally, or if these other names don't rally, or no, it can't do this. And then it changes really fast, and it changes back, and the correlation shifts, and then the price action shifts. And it's disorienting in itself. And so I think that that is really, really key. What we're really seeing, many CEOs and fund managers have recognized this new environment and understand how to pitch themselves as a new meta that will change everything in the world. So if you can control the way that someone views the world, they'll take a negative return to hold your stock, your ETF, your investment portfolio, and they'll only anchor to the positive developments that confirm their views. And I think there's some element where a lot of financial advisors in the past have underperformed the market in a massive way, and now they're coming to kind of a bit of a reckoning, and the information is a little bit of a positive. But on the flip side, now people are going to the opposite extreme where they're saying, oh, you know what? I watched, 40 or 50 hours of podcasts with this one guy. At the end of the day, if you watch 40 or 50 hours of podcasts with a single guy, you're probably going to start believing what he thinks, right? You're going to say like, oh, this guy really understands the world. I want to buy the stock that he runs, or the company that he runs, or the investment fund that he runs, or something like that. And the problem is that a lot of individuals will see that environment and take advantage of that. I think that we're not going to go through a list of names or anything like that, but the everyone kind of knows in general the ARK ETF is the perfect example of that, right? You have all of this AUM that is basically never sold, and it's underperformed the market in one of the largest melt-ups and meltdowns that we've ever had in history. And, we're still way below all-time highs, and people just believe, even though they could have, shifted, taken a gain, bought the index, whatever it might have been, this is one of the largest actively managed ETFs in the world. And it's such a great example of how this is functioning on a broad basis. And there's no, kind of thought given to like, wait, why is this happening? And so the end result is we have a world where people are not focusing on the wrong questions, not only focusing on the wrong questions, but everyone around you is actively trying to misdirect you and harness your attention on the device that just sits in your pocket and is, the place that you always turn to when the world is uncertain. So that's the situation that we're in. And as that is taking place, as that internal misdirection is taking place, you have the biggest risks in the market everyone's just been desensitized to. You have all these new phrases for why things are the way that they are and why you're a little ridiculous. We've just normalized all the tail risks in the market, and no one sees the risks because they're too busy monitoring the situation. As a result, the closer you look, the less that you see. Stack on top of this the fact that the microstructure of the market has turned into a highly inelastic mechanism that has never, really seen a true market correction with this amount of 0DTE volume and leverage products. So the chart here showing how much notional open interest, volume we have is indicative of where we're at right now. I mean, we have a massive amount of 0DTE calls and puts traded every single day. And we're just normalizing, especially for, retail players. I know a lot of institutions are using these products as well, but we're just normalizing them in society. And the thing that is clearest on the retail level is that there's 3 billion, and this is only for Kalshi, there's more like 6 billion overall on a weekly basis in betting volume on prediction markets. And, Kalshi and Polymarket have been the natural parts of everyday conversation, despite the fact that the overwhelming majority of users lose money. And so it's just been normalized that the society as a whole. Everyone is talking about how the system is stacked against them and how horrible everything is, and then they're giving $3 to $6 billion a week to the establishment. $3 to $6 billion, right? And you can say, oh, well, maybe they're going to win here and there. Sure. But on net, there's been a lot of studies that have been done on this. On net, basically 99% of every individual who's on prediction markets lose money. And all of the money goes to market makers or whoever's running the platform. And so here's another kind of breakdown of where we're at with 3 billion for this. We have 6 billion overall, and this doesn't even include any other websites that are focused on all the sports betting and other things. So, we basically institutionalized and normalized a wealth transfer from the poor to rich and called it the freedom to hedge your risk and express yourself. This is the problem, is that it's not saying, hey, listen, this is Vegas, this is gambling. You just need to understand that when you're going in, don't risk more than you lose. It's always framed in the marketplace of ideas as this is giving you control and freedom. And that's the problem. That's the divergence that's taking place. And the newest billionaire class is basically being built on top of that. And so that's really the situation that we're in right now.
And we're seeing them use the words, right? Go back to that sentence real quick. The words freedom and express yourself just leans more into this, like, almost this wokeism, right? This leaving values and community and all that behind and going more towards freedom and self-expression. And it's like, this is the institutional extraction of the movement that was just culture before, right? We talk about like the, we're getting so desensitized to these like crazy shootings and like that they last like 2 days in the news cycle and then we move on as if it's normal, right? When in reality, back in 1998 or something, if like, I'm guessing people in the chat out there probably don't even know what happened in San Diego a couple days ago with the shooting at the mosque. Transgender couple come in, kill a bunch of people, kill themselves. Didn't even see it hit X, really. Didn't even see it hit the news. Kind of a big deal in San Diego where I live. And that's just another thing of like, it's unbelievable how suppressed that volatility has gotten. And it's this whole like you're out for yourself mentality. And by the way, we talked a little bit about this as well. CME is going to be making a push here too. And I have some connections with people that are closer to CME than I am. That's the trading exchange, if you're unaware. They're going to be pushing hard into prediction markets, and they don't push hard into anything. So that goes to show you the opportunity that they see to take advantage of this, just like calcium poly market.
Yeah. I mean, I couldn't agree more. And I think that, there's a lack of awareness around these, or they've just been normalized, right? I think that, in the past, you might actually have honor and shame in a culture where you say like, how can you do that? Right? Like how can you go to that place or do this thing, or why would you do that? And people are now saying like, oh, let people be free to express themselves or whatever it might be. And I think the unintended consequence of that is how exactly that is functioning. Let's go over this question that you brought up, James, about, is this an opinion or is there research behind this? And do you know when this came in to reference which part of this?
Just now. It's the last question.
So are they referring to the?
I'm guessing it's. No, I'm just guessing it's about this article in general, this think piece. Which, I mean, if I got to let you speak on it, but to me, it's clearly an opinion.
Well, so yeah. Here's great breakdown. Number one is, I guess we'll just lay all this out. Number one, all of the volume that we see on Polymark and Kalshi is all pretty clear. So we know that all of that is taking place. If you go look up how exactly there were some research pieces that came out where some investigative journalists did pieces where they showed how much money people were losing on Polymarket and specifically Kalshi. And Kalshi actually tried to file a lawsuit against them, and then they lost and they pulled it back because they realized, or because the information was true and it wasn't defamation. And Kalshi has continuously tried to file lawsuits against people and to basically stifle all the negative news. You can just go look up all the lawsuits that they're filing right now. And on top of that, what we are seeing is a lot of also lawsuits against them on the back end regarding how exactly they're involved in making markets and the fees that they receive on the back end, or the payment for order flow or things like that. And then on top of all of that, what we are seeing is that Kalshi has run probably the largest financial media marketing campaign in modern history for normalizing betting markets on TikTok, on Instagram. If you go across all those platforms, everyone is talking about Kalshi. If I say something, I guarantee you, if you go look and search for tweets from big accounts that are saying anything negative about Kalshi, I guarantee you there are basically Kalshi reply guys underneath it that work for Kalshi that basically try to tear the idea apart and basically discredit the account that says it. And if you, I'll just say this: I've been offered money from different sources just to retweet news information from different accounts. So, for example, like let's say you get an account, like if I share something from like Financial Juice or something like that. I don't, I'm not getting paid by any of these guys, but Financial Juice or any of the other guys that like have these squawks, right? These are all pretty straightforward guys. I mean, I'm sure they're monetizing it somehow, right? But a lot of people with larger accounts have been offered money not to comment or support, but just simply to retweet news in alignment with what your view is or anything like that. They're like, oh, we don't want to push anything on you, just from other accounts on news, just to normalize that they're actually reputable sources. Like, oh, large players are talking about this. They're not talking about these markets being good or bad, but they're talking about them. This goes across a lot of different avenues. There's a lot of marketing dollars that go in on the back end for how this is taking place. And like, I'll just say this is like, it's basically impossible to have the people like talk, like especially creators who use their platform. It's basically impossible for them to actually talk about a product, because people are very careful now about how they talk about products, right? Like I have to be careful about how I talk about other people's products, right? I think it's post FTX, everyone's very careful about talking about other people's products because they don't want someone to accidentally invest in and then come back into their comment section later and destroy their reputation. And so, there is a lot of anyone who is explicitly talking about Kalshi or anything like that, like I guarantee you they're getting paid for it, or Polymarket or anything like that. And so like that is the environment that we're in, and it's being borne out in the actual data. And we're seeing, again, all of the numbers on the website, and especially on-chain stuff and anything that you map, weekly volume is just going through the roof on all these places. And the majority of people are losing money. There's always people, probably a small majority, who are making money, but that is the minority of people, right? And that's the entire point, is like, this just goes back to the contracts that we have. There's literally no asymmetry in, like, it's very hard to get asymmetry in binary contracts, right? You're basically doing a coin flip at best. I mean, anyone who is trading things like hikes or cuts or anything like that, as soon as it settles, you don't have more upside. You get a limited upside on binary contracts, which is how the markets are structured. Whereas if I buy a SOFR contract and it settles, or it moves to the level that I wanted, and then on top of that, it continues to go because we price more rate cuts or hikes, then I get to experience that upside, and I have unlimited upside in some capacity, or further upside that is uncapped. Whereas in binary contracts, by definition, their structure is to have a very low risk reward, and so it's very challenging to make extreme payouts, except in very, very niche extreme events, which by definition you have to have an informational edge or just get really, really lucky. And so the entire structure of the market is set up for low risk reward bets. When you look at the entire marketing around it across every single platform, it's the largest it's ever been in history in terms of the amount of money that's gone into that. And when you look at the daily volume, then that is one of the biggest things when you understand how like given the risk reward structure, that it's very difficult for people to trade in and out of these contracts, especially if you want to make money, because the commissions are still pretty decent. So all of these things stack on top of each other. And if you're any trader, I mean, James, you know this from, if you're trading the order book and there's round trip costs, right? There's commissions that round trip things, and you're always thinking about, oh, like, am I buying the outright, or am I buying this calendar, or am I buying the spread because now I have double the commissions, right? Any real trader knows how all those things stack up on top of each other, and you look at it and you're like, that doesn't sound like a great place to execute.
Yeah, I agree. I don't have as strong of an opinion on just generally all of this, but I do find it really interesting to think about the stifling of just vol in and across like culture, and I don't really see the end game yet. Like I don't see how it all end. I don't get the timeline and the does this end in like almost like a rounded top scenario where everything just slowly crumbles and then it kind of falls apart quickly, or if there's some sort of like moment in time
Right.
that sparks in a sense a revolution. I don't what's your kind of thoughts around that, even though obviously nobody really knows?
Well, I think we have an environment where everyone has figured out, the Fed has figured out how to bail out the system and kick the can down the road. And every other, like the Fed has figured out how to do that. And I think every other agent in the economy has figured out how to do that. How do I kick the can down the road so that I can push the consequences of this into the future? Not just on a nominal basis, but on a real purchasing power basis in the ideas of society in every single level of the market microstructure and everything. I mean, this goes back to just how it's been normalized, this idea of passive investing, which, by the way, like I think that there's a ton of merit to it. But the problem is that, if I am putting my money in passive vehicles, which it's the only game in town now, it's all becoming one trade, is that when you buy and sell, it buys and sells indiscriminately. And there is not the same liquidity in the S&P order book, in the stock market, that there was in the years past. And you have a lot more concentration on passive flows. We're over 50% now. I think, Mike Green just did a thing the other day where he talked about how, what was it again? If we get to 65% or 70%, that's when there's a really dangerous scenario that begins to pop up.
Yeah, he said we're at 55% passive flows right now, or the market is driven by 55% of passive flows. And based on their work, if you get to 65 to 70%, it starts the ticking time bomb and is basically impossible to avoid a extremely high crash. Now, look, that's just another thing we've heard, right? And there have been a lot of things that have proven Mike Green wrong over many years. So, like, take that for what it is. But at a certain point, I'm like, no, at a certain point, it turns the tables to like, you know, his thesis might make a lot more sense at that 10 or at 15 extra percent of passive flows, right? And
Right.
the one thing I think we've talked about that I really wonder, and I do this as a test with my like normie friends, is I'll say, what would you do if the market went down 20%? Like, is that a big deal to you? Do you know where your money's invested? Do you have any idea? And they'd be like, and most of the people are like, no, like, doesn't matter. Kind of, it goes up and to the right, and like I'm working and it's kind of fine. And I'm like, right. So like in COVID, it went down 30%, but within a month or two, it was back up, right? And they're like, yeah, so it's like whatever. And I really don't feel like people have been put. You know how we talk about markets put people to the test constantly? They push you
Right.
to your limit. They have not been pushed to their limit, and I feel like there will be a point of that where they're going to have to make phone calls and make decisions that they've never had to. They've never stepped foot into this arena, and it's going to be intimidating. It's scary, and they're not going to know what to do. And that moment, I think, is going to happen within the next 5 years, where like the average dual income household that seems like life is just fine, but they live completely up to, nobody lives beneath their standards, right? Or
Right.
beneath their means. Everybody lives like right at or barely above their means, expecting like a bonuses and increasing. And I'm like, man, like, what if we do have the Japanese situation where it has a 10-year period of just like stagnant pseudo yield curve control? We take it on the chin for 10 years. What kind of blenders does that put people in? So that's how like I think about all this, and the Mike Green thing, right? I think that leads to that. And it's just, again, it goes back to our whole scenario planning thing, is like, how are we personally going to act in there? What are the signs we're looking for that ultimately lead to that, so that we're hopefully in a position and on sides heading into those predicaments?
Yeah, I think this goes back to the idea that Naval talked about on his podcast the other day, where he says, doom is easy, optimism requires creativity. And I think the entire point is that,
That's good.
Us as traders, we have to think about all the scenarios, and we actually have to have a small margin of error. So we have to think about what the good and the bad is. You have to be able to think about the worst case scenario, but you also have to be creative enough and optimistic enough to be able to make money in any scenario. And I think that there is, I don't really subscribe to any ideas of a perma bull or perma bear. I reject all of those ideas. I think it's just all about how exactly is the current situation set up, and how am I going to adapt in light of that? Because this idea that you need to be permanently bearish or bullish is in itself limiting belief that is a misconception. And I think that, I look at how exactly I need to be optimistic because of the things that are taking place. And I think that there is so many factors in the United States of America that create the upside that exists. For example, this chart that I have in the slide that shows the S&P versus the equal weighted index. This is a representation of American exceptionalism, specifically expressed in the top 7 stocks in Mag 7. And you can see us moving up, right, to the upside, where the S&P outperforms the equal weighted index. That in itself represents American exceptionalism. The U.S. has the best companies in the world, period, on AI, compute, and basically any high-level piece of software, government intelligence, whatever it might be. It is the best in the world, without question. And the earnings in themselves and their impact, and the fact that every other country comes to the United States to spend money on all these products, is in itself an indication that it's not just clout, but people actually are constrained to. That's one of the things on, people don't like Palantir, but Palantir the entire thing around Palantir is that, sure, there's a lot of things that we don't know that are covered by security clearances or things like that on the government contract side. However, when you see countries forced to renew and basically say there's no other person in the world that can do this service for us, we have to go again with Palantir and renew our contract. And other countries in the world do that, and the US does that as well, and the DoD does that. Sure, you don't know what's in the black box, but you know that all the people that do know what's in the black box will not let go of the black box, right? And that second and third order thinking, or thinking about how do you extrapolate into the unknown, is basic kind of extrapolation of like what exists, what doesn't, how do you think about the incentives. The absence of information is amplified, and then people in the news media go and talk about whatever it might be, and they slap these narratives on whatever it should be, or whatever they think it is. But there are, on the flip side, again, this chart right here, the fact that you have the concentration in Mag 7 is in itself carries a risk. There is a risk premium, and you have had a concentration in the top 7 stocks, and that's not necessarily in itself a bad thing, is because those top stocks are monopolies for a reason. However, there are risks around that. And especially when everyone gets into the same trade, those risks are amplified and they get priced in. And it's not dooming, it's saying, what exactly are the scenarios where I need to be able to adjust and change my perspective, or maneuver in market volatility. And as that is occurring, we have equity valuations at all-time highs. And people will say, oh, well, it's just part of AI. Think about the problem with that idea. If it was just about AI, where would you see valuations high? Only in AI names, or only in the respective index that it's connected to. But we're actually seeing all-time high valuations in the Nikkei, the DAX, the FTSE, every major stock market in the world, which begins to tell you, oh, wait a second, my simple thesis of it's just AI and it's actually justified. Sure, there is definitely those dynamics in AI. However, on a global basis, there's actually something larger at play that you can't just brush over. And that is that there's a surplus of dollar liquidity in the system that exists that is unlikely to be sustainable, especially when we have these types of inflationary shocks and you have long end rates begin to put some pressure on things, but they're kind of weighted against these AI flows. So right now, what we're seeing is long end rates have pushed up a bit, probably going to push up a little bit more. But the entire thing is that when you have these high valuations, it is a reflection of the surplus of liquidity in the system. And old school people will say, oh, it's kind of funny to see the progression of people over the years. That quote unquote value investing worked in the 80s really well because interest rates were incredibly high. And then you'll see all these people that said, oh, I used to believe in value, but now I believe in all these other kind of random things. And at the end of the day, valuation is a function of liquidity, which is a function of interest rates and FX, which most value investors don't spend a lot of time going over, because they spend all their time, like Warren Buffett, going over what are the best companies in the world to buy, which is totally fine. It's great. But if you're trying to sell those companies when they go to a high valuation, it's really tough. And it's not just in the main indices, it's also in the Russell 3000. So all of the smallest stocks, and not only in the United States, but also in Japan, they're at an all-time high valuation, higher than 2021. So that frames, and that should make you ask questions. Wait a second. Why have I been kind of like taking this valuation factor and just pushed it under the rug and said, I don't need to think about that? Why has that been normalized, right? And people will say like, oh, well, there's just a lot of money in the system. The Fed prints money. We can't do anything about it, right? Again, another kind of just normalization of what people, like how people think the system works. And then they're just going to be like, okay, well, let's just scroll headlines and see what happens. The concentration of the period of time that we're in right now is that high yield debt sensitivity companies, so basically all the riskiest companies in the United States, are literally outperforming all the highest quality monopolies in the United States. That should give you cause for caution. Pause for caution. Caution for pause? I don't know.
That should give you pause for caution.
Which one is
God
it?
damn it. That doesn't sound right. That should give you pause. Let's just move on.
Or neither of us are bright enough. Um, uh, the fact that
Guys,
high
it's
yield.
been a long week. It's been a long week, okay? Our brains are cooked and Friday is still remaining, you know?
Oh my gosh, let's not talk about Friday again. The fact that we have this situation, pause for concern. Thank you.
Yes. Oh my gosh.
Thanks, guys. Cause for concern too.
See, this is why the rising tide lifts all boats, man. The
Yeah.
comment section saving us.
We're gonna build you up guys all up all week, and then you guys have to really help us get through on the last 2 days. This chart, I think, shows that we are having an extreme in capital rotation out the risk curve, where the highest risk names are rallying the most. And so the entire point of these factors is that they represent real risks in the system, but everyone has normalized their existence instead of understanding volatility compressing. And this is kind of the famous saying from Nassim Taleb's book. If you look, we're just going up and to the right, and everything is fine because we've always been fine. And the past has always shown that we go up and to the right. But if you understand that you're on a certain side of a trade and that, you know, in 1,000 days, and you don't want to be the turkey who gets killed at Thanksgiving, this kind of represents the turkey's well-being, where they're getting bigger, they're getting fed more, and they're thinking, wow, I'm feeling pretty good. I'm eating a lot of food. I get to kind of just do whatever I want, and life is good, and I just get better and better and better. And then doesn't realize that there's a tail risk at the end where he goes to zero. And so when you look at things in the system, you always want to look at, how is this functioning? Is this compressing vol or is it absorbing volatility? Is the system creating more fragility or anti-fragility, as Nassim Taleb would say? And so this is, something I'd love for James to kind of touch on a little bit more on how you think about things, whether it's risks that you take or things that you kind of do in life, where you're thinking, am I betting on the tail here? Or am I, picking up pennies in front of a steamroller? Or am I actually, taking, really massive asymmetric risk to bet on that tail event? How do you kind of think about not kind of taking a trade that could eventually blow you up?
Yeah, I think that's where just experience comes in, plus just my interaction with you over time. Is I've shifted completely to trying to ignore the shiny objects that might seem like quick hit good opportunities, and I try to really go back now to, like, where does this idea even come from? Why do I like it? Why does it feel good to me? What's the incentive here for me? What's my time horizon on this? What is it going to do for my overall growth in this space? Does this promote longevity for me here? Or am I putting at risk like a massive blunder? And if I can answer all those well, I'm open to taking any and all bets, right? But for bigger, more concentrated bets now, it's much more interesting to me to uncap my upside and cap my downside. And now that's how I approach all of my bets.
Yeah.
It's like, how can I almost cheat the system? I don't think a lot of people even believe it's possible to have 10 to 1 risk reward on things. And I just do. I just think that's true. I think if there's the alignment there and you can stack enough things, I think we've seen that that's possible. And I've also seen the other side of that. I've been in crypto a long time. I've been really close to the blade and gotten poked quite often, right? I've been part of hacks. I've been in things that you think are super safe, and somebody fat fingers the entire thing, and all of a sudden that protocol is dead. Like, all the things you thought were safe, that really teaches you a lot. Crypto teaches you a lot, even though, a lot of people don't like crypto in general, but it does prepare you for a lot of things. I think it prepared a lot of crypto people for this AI run, right? Because they're able to think bigger, to think more expansively, to think about asymmetry and downside a little bit better than I think the normies in TradFi land can. So that's how I think about things now. But if I'm living my life, honestly, I kind of want to live my life like that turkey, because like that just sounds like at the end of my life, I'm going to get shot in the head, and that'll be good. Be great.
Yeah, I think the understanding which bets that you're taking is really helpful, because sometimes you want to bet on the tail and sometimes you don't want to bet on the tail, right? And you want to be long life, right? Like you want to be the differentiator in long life. And I think what we are seeing is that when you stack these other factors in macro, where you have 1 year real interest rates are flirting with negative territory, but we haven't gone all the way down yet. The rates in Japan are negative, right? Like real interest rates in Japan are all negative right now. It shows you that you basically get paid in real terms to take out debt. Think about that. You get paid in real terms to take out debt in Japan right now. And that is one of the reasons why you can have carry trades begin to build or unwind or things like that. And so long end interest rates for every major country have been cross collateralized now, so that everything is becoming one trade. And I think this is one of the most dangerous things in the market today, is that it used to be that interest rates would, go based off of the individual economies. Something good is happening here, something bad is happening here, they diverge. They're not really correlated. But now, when we have a world where everyone is trying to export their goods to the United States, the markets all move in lockstep together now. And it's hard to say like, oh, I want to bet on German bonds or bonds or whatever, and then realize like, oh, it's the same trade as the US, or it's the same trade as gilts, right? And there is going to be some differences and you need to make some distinctions. But on a broad basis, we have cross-collateralized countries. And the US current account is at one of the most extremes it's ever been in history. We're importing way more than we're exporting, and it remains negative. And so that shows how cross-collateralized we are with other countries when we're importing more than we're exporting. And now it's just like if I give you a job and now, you start depending on me for $5,000 a month. And then you begin to say like, oh, you know what? This has been going really well. Why don't I go try to take some other bets or try to invest in these other things to build my business that cost $2,000 a month? And I'll just, try to, make the spread a little bit and try to adjust. And the idea is that, someone can begin to rely on that income or that flow to structure their risk. And if it changes, their entire kind of reality could fall apart. That's the entire idea behind the US and them importing more than they're exporting. The whole world is dependent on them. And so as social media takes a dominant stance in financial markets since COVID, it has used attention as its currency. The result is that everyone's become desensitized to the actual systemic risks building under the surface as clickbait headlines flash across the screen. I mean, just think about how many people have been calling for a bear market for years now, and now you kind of can't just even trust them because it feels like the bear that, or the boy that called wolf, right? That's just like, I don't know, he's been wrong for so long, I just can't really trust him. Oh, just another guy, right? And to be fair, like there are people that just, doom and they don't really know how the system works. So I think that's the majority of people. But AI is creating unparalleled progress across every domain, but it's retooling every part of the economy and financial market. But the unintended consequence is this is also compressing the tails. So AI functions as a form of leverage in the system that empowers those with specialized knowledge, but amplifies unintended risks. So here's a tweet by Naval where he talks about this idea of fortunes require leverage. Business leverage comes from capital, people, and products with no marginal cost to replicate, code or media. And the entire idea is that code and media are permissionless leverage. They're the leverage behind the newly rich. You can create software and media that works for you while you sleep. And the takeaway is that AI is both speeding up the entire system and desensitizing people to the underlying risks. And we are seeing the impact of this in real time across social media, financial markets, and the economy. I mean, this is just such a great example that we saw live stream the other day, where you have, the robot working 24/7 to be able to outwork the guy. And that is, think about the fear that could take place in society for low skill labor when they say like, oh, like they start working side by side with a robot and they say like, oh, well, we're just transitioning some things. Like they're going to say like, no, I'm not going to keep staying at this job, or I'm not going to keep doing this if the idea is that I'm eventually going to be laid off. And so the risks, in my view, in the underlying system are building. And here's the thing, I'm not a doomer, because I think there's going to be a lot of jobs that are created, but there's going to be a divide between the people who want to adapt to that and not, because there's always going to be people that live in the past and say, can't we just do X, Y, or Z? And so I think it's very telling when one of the largest universities in the world booed off the CEO of Google off stage for talking to them about AI. I mean, if that isn't the sign of the times, I don't know what is. And so risk and volatility are compressing across culture, social media, technology, and the economy, equities, interest rates, FX, even down to the intraday ranges in markets with option flow. And small changes transmit through the system with a non-linear impact in a way that has never been seen. The same driver that is compressing volatility is also creating a continuous feed of disorienting news that is intentionally desensitizing you to the underlying risk. The narrative, though, that is being sold is you should monitor the situation. And as a result, the closer you look, the less that you see. That is really the idea behind this entire article right now. And I think it's just so critical. I'll, kind of toss this back over to James, but it's so critical to kind of take a step back and look and think like, okay, what are the information sources in my life? How am I, in the same way that an athlete needs to get sleep before he has practice the next day or a game, you also need to think about how am I setting myself up for success, for how I'm taking in information, how I'm thinking about things. Am I reading? Am I listening? Am I talking to the right people? All these basic things so that you are more aware of the signal in the system instead of desensitized to it. And so I think that's one of the biggest takeaways for this article.
Yeah, I think a lot of people still are in this this idea that you're siloed in markets. You're like siloed from the rest of your life, and that what you do away from the screen doesn't impact what decisions you make while at the screen. And the more time you spend at the screen, it's like in poker. Like there's always this idea like if you play an hour online or play an hour live, you should study for an hour, right? You should almost have more time away from the table than you have at the table to impact your decisions in hands. And I think that's somewhat similar here. Is like we spend a lot of time sometimes with intention about a specific subject or just shooting the shit until we arrive at a certain point to quote unquote improve ourselves away from the table so that when it comes to an actual execution, we are at our best. We are at the peak tip of our sword to make optimal decisions. And that gets harder and harder the more you trade, right? I was trading 50 to 100 trades a day for a long time, and I had to come in every day as good as I could and ready to make those decisions. And I think you need to go reflect on like, how are you spending your time off the screen? Who are you talking to? How are your relationships? Like, how is that affecting things, right? Like I have a wife, I have kids, I have to think about where I'm spending my money and my resources. And like sometimes I feel like, oh, I'm just behind, man. And that might bleed into me pushing a trade a little bit more than I should, right? Maybe that trade doesn't call for that, but I do it anyway because I'm like, I'm going to try to squeeze a little more juice out of this. And I'll bring this guy up real quick because I think it
Yep.
shows us a little bit what we're talking about here. But like shower songs, right? Really in the comments, a little distracted from the topic at hand today because he's wondering why PER is underperforming hype so drastically, right? And I'm holding and I'm adding, but I'm sweating. And then actions speak louder than words. I guess I loaded up while price has been diverging. Would be great to get some sort of non-AI explain. Look, like to me, this is a person, and I'm glad you're on board, and I'm glad you're here with the streams, and I'm glad you're kind of investigating this. But to me, it's clear that you haven't gone back and really thought through the thesis that was laid out here. And if you had done that, you'd understand why we have a bet on Per and why we think they can outperform and why they have been outperforming over time. But it seems like this is somewhat new to you. You might have been aping a little bit later. You might have been putting on a little too much position size. Why is that? Have you been underperforming? Do you feel like this is a catch up trade for you? Do you feel like it needs to work right now? Well, maybe then your sizing was off a little bit too. So the rest of your portfolio look like? How are those performing? So you're coming here and you're outsourcing that responsibility onto us and hoping that I have some magical answer for you as to why Per is going to catch up today and it's all going to be good. But that's just not how it works. And I think that all goes back to what we're talking about here. So I do think it's related. I think all these conversations are related. I think it all comes back to like the trades you make. And, hopefully, Shower, I don't mean to be a dick, but like at a certain point, we can't sit here and play, the little comfort guitar for you, because they could be selling into this, preparing for a new spot buy, right? They could be diluting or whatever, preparing for something else. We don't know. So you have to set your trades up without complete information, with a bias, with risk reward, and if you're holding this for, it sounds like you'll be out of the position within a couple of weeks. If I had a gun to my head, you won't be in this position in 2 weeks. Now, if you're in it for 2 months, that's probably because you've thought through this thesis, you have it priced accurately, and you could ride these day-to-day swings. So a little ranty there, but I think it's important.
No, I think it's great. I think that, if you give the smallest piece of information to a skilled executor, he'll figure out how to make money with it. But if you give the greatest edge to someone who always operates out of fear, it doesn't matter how good of a piece of information you can give them, they'll always figure out how to screw it up. And I just think that's like one of the things that I always think about is that you're the difference maker in every situation that you're in. And it's all about how you decide to be the difference maker there instead of kind of always chasing around. So I think that's really key. So I think we covered a lot of really great ideas today in the stream, and we're going to wrap it up. But tomorrow we'll be covering more on the entire trades that we're talking about, what's kind of happened over the last week. We didn't really touch on NVIDIA earnings. There's actually some interesting things that I want to cover that have developed. Shocker that it didn't move the market at all. But it was supposed to, but it didn't. But we'll cover some more on that tomorrow, and we'll continue laying out the macro regime and how to kind of operate within it. So those are the main ideas for today, everyone. Everything's laid out on my website, on James, everything else. You can go find it. And with that, we will catch you guys tomorrow morning.
Cheers, guys.